My dear friends, welcome back. Over our past conversations, we've built a strong philosophical foundation. We've discussed the margin of safety, we've trained our minds to resist market emotions, and we've understood Mr. Market's moods. But now we arrive at the very heart of intelligent investing, the question that separates true investors from mere speculators. How do you actually calculate what a business is truly worth? This, my friends, is where we roll up our sleeves and get to work. I want to take you inside my personal study to share with you the exact methods I recorded in my private notebooks, methods too detailed for my public books, but essential for any serious investor. Forget the complex Wall Street models for a moment. I want to show you how I thought about value in the most practical terms possible. Let's start with the simple truth. A business is worth all the cash it will generate for its owners in the future, discounted back to today's dollars. That's the essence. Now, how do we apply this without getting lost in endless predictions? We use a framework. We build our estimate not on wild guesses, but on conservative, verifiable facts. The first step is always the balance sheet. Before we even think about future profits, we must ask, if this business stopped operating today, what would its parts be worth? This is what I call the net current asset value, a concept so powerful yet so simple. You take all the current assets, cash, inventory, receivables, and subtract all the liabilities. What remains is the net current assets. Then, if you can buy the company for less than this amount, you're essentially getting the fixed assets, the factories, the equipment, the real estate for free. This was my most conservative approach, and it served me well through the most uncertain times. But for most wonderful businesses, we need to look beyond just the liquidation value. We need to estimate the earning power. This is step 2, calculating the normalized earnings. We look at the past several years of profits. We adjust for any one-time events and we ask, what is this business likely to earn in a normal year? This is not about projecting growth. This is about establishing a realistic baseline. The third step is the most debated, choosing the right discount rate. This is where your margin of safety is born. The higher the discount rate you demand, the more conservative your valuation becomes. I typically used a rate that reflected the risk-free return plus a substantial premium for the uncertainty of business ownership. Now let me show you how this works with a real example from my own career, a calculation I did for a simple manufacturing company back in 1954. Let me walk you through that 1954 example in detail, for it perfectly illustrates the practical application of these principles. The company was New York-based Eureka Manufacturing, a producer of reliable industrial pumps. The market was optimistic about the post-war boom, and Eureka's stock had risen to $45 per share. Wall Street analysts were projecting endless growth, but I sat down with their annual report and my calculator. First, I went to the balance sheet. Their current assets totaled $3 million. Their total liability stood at $1.2 million. This gave them a net current asset value of $1.8 million. With 100,000 shares outstanding, this meant the net current assets alone were worth $18 per share. The market price of $45 was far above this safety net. This told me I wasn't getting a bargain on assets alone. Step 2. I examined the earnings. Over the previous 5 years, Eureka had earned an average of $250,000 per year. However, 1 year had been exceptionally high due to a large government contract. Adjusting for that, I estimated their normalized earning power at $220,000 per year. This translated to $2.20 per share. The market price of $45 represented a price-to-earnings ratio of over 20. This was not cheap. Now for the crucial third step, intrinsic value based on earnings. I applied a conservative multiple to those normalized earnings. Given that Eureka was a stable but slow-growing business in a competitive industry, I believed a fair P/E ratio was 12. This was my discount rate in action, a required return of about 8.3% from earnings alone, plus a margin for uncertainty. Multiplying the $2.20 earnings by 12 gave me an intrinsic value of $26.40 per share. The market was asking $45. There was no margin of safety. In fact, there was a massive overvaluation. I passed on the investment. 6 months later, the special government contract was not renewed. Earnings fell back to my normalized estimate, and the stock price collapsed to $25. The crowd that bought at $45 was shocked. I was not. The numbers had told the story all along. This is the power of a disciplined valuation process. It doesn't require genius. It requires consistency and conservatism. Now let's fast forward to your world. How do you apply this to a modern technology company that has few physical assets? The principles are the same, but the emphasis shifts. You must pay even more attention to the durability of those future cash flows. Is the company's competitive advantage strong enough to sustain those earnings for a decade or more? This is where qualitative analysis meets quantitative discipline. You must become a detective of business quality and then use that judgment to inform your conservative financial estimates. The formula doesn't change. Find the normalized earnings, apply a conservative multiple that reflects the business risk, and then insist on buying at a significant discount to that calculated value. The margin of safety is your protection against the unknown, and it is non-negotiable. Now, I want to address the most common and dangerous objection I hear from modern investors. Ben, your methods are outdated. Today's companies are about growth, potential, and disruption. You can't value a tech giant using old-fashioned book value and earnings multiples. My friends, this objection stems from a fundamental misunderstanding. The principles of value investing are not anchored in specific accounting metrics. They are anchored in the timeless logic of business ownership. Whether you're buying a corner bakery or a revolutionary software company, you are still buying a claim on its future cash flows. The question remains the same. What are those cash flows worth today? The tools simply evolve. Let me prove it to you. Imagine a hypothetical modern software company, CloudLogic Incorporated. It has minimal physical assets, some computers, office furniture. Its balance sheet shows more debt than current assets. By my old net standard, it looks bankrupt, but the intelligent investor looks deeper. We look at the qualitative factors that will drive future cash flows, the annual recurring revenue, the customer retention rate, the gross margins, the total addressable market, and the scalability of the business model. These are the modern equivalents of a factory's production capacity or a retailer's prime location. Then we make a conservative estimate. Let's say CloudLogic has $100 million in annual revenue, growing at 30% per year. The amateur projects this growth to infinity. The professional says, growth will slow. Competition will emerge. Let me model what happens if growth decelerates to 10% in 5 years and then to 5% in 10 years. We calculate the free cash flow for each year, discounting it back to today's dollars, using a rate that reflects the high uncertainty of the tech sector, perhaps 12% or 15% instead of the 8% I might have used for a stable utility. This discounted cash flow model is the modern embodiment of the same principle. Future cash discounted for risk. The calculation is more complex, but the core intellectual discipline is identical. You are still estimating future cash flows and demanding a price that provides a margin of safety against your errors. The biggest mistake in modern investing is not skipping the book value calculation. It's abandoning the margin of safety principle altogether. People pay 50, 60, or 100 times earnings for growth stories with no cushion for error. When the growth inevitably stumbles, the collapse is catastrophic. My method, updated for your time, would be to calculate the intrinsic value through a conservative DCF model and then refuse to pay more than 70% of that value. If the market is so euphoric that no wonderful tech company ever reaches that price, then you do not buy. You wait. You hold cash. You remain disciplined. This patience is the ultimate test of the intelligent investor. It's easy to be disciplined when no opportunities exist. The true challenge is to remain disciplined when everyone around you is getting rich cutting corners. Remember the core truth. The laws of economics have not been repealed. No business, no matter how revolutionary, is worth an infinite price. Your job is to know what it's worth to you as a conservative business owner and to have the emotional fortitude to walk away when the price exceeds that value. This is not a limiting factor. It is your liberation. It frees you from the frenzy of chasing fads and allows you to build genuine, lasting wealth on the solid foundation of value. My friends, we have journeyed far together into the heart of what it means to be a true investor. We have moved from philosophy to psychology and now to the very practical mathematics of value. But as we reach the end of our current conversation, I must share with you the most profound truth of all. All of this calculation, all of this discipline, is ultimately in service of a single beautiful goal, the achievement of not just financial freedom, but mental freedom. The freedom from anxiety when you open your brokerage statement, the freedom from the compulsive need to check stock prices every hour, the freedom to live your life knowing your financial future is built on a foundation of rational principles, not speculative hopes. This is the ultimate dividend that intelligent investing pays. Now, I want to leave you with a complete actionable framework, a checklist you can use for the rest of your investing life. Think of this as my final gift to you, a summary of our conversations distilled into a practical tool. The Intelligent Investor's Checklist. Step 1, the qualitative sniff test. Before you ever open a financial statement, ask these questions. Do I understand how this business makes money? Is its product or service still likely to be needed in 10 years? Do I trust the management to act in my interests as a shareholder? If the answer to any of these is no, you walk away. No calculation is needed. Step 2, the asset inspection. Open the balance sheet. Calculate the net current asset value per share. Is the stock price trading below this? This is the ultimate bargain, though rare today. If not, what is the tangible book value? It tells you the worst case scenario. Step 3, the earnings power value. This is the core. Scrutinize the income statement over 5 to 10 years. Normalize the earnings. Remove one-time windfalls and losses. What is the business's sustainable earning power? Apply a conservative P/E multiple to these earnings. For a stable, predictable company, 12 to 15 times. For a more volatile one, 8 to 12 times. This gives you your core intrinsic value estimate. Step 4, the growth reality check. Here is where most fail. Do not project high growth rates far into the future. If you assume growth, be brutally conservative. Model a deceleration. A company growing at 20% today is unlikely to do so for a decade. Assume it slows to 10%, then to 5%, then to the rate of the overall economy. Step 5, the margin of safety calculation. This is your final gatekeeper. Take your intrinsic value estimate from steps 2, 3, and 4. Then demand a significant discount. I recommend at least 25 to 30%. This is your buffer against error, arrogance, and misfortune. If the current price does not offer this discount, you do not buy. You wait. This is the most critical step of all. This checklist is your armor. It is the systematic process that removes emotion and replaces it with discipline. It turns the art of investing into a science of probabilities. Do not skip steps. Do not make exceptions for a great story. The market is filled with great stories that ended in tragedy for those who forgot the numbers. Your path forward is clear. You are no longer a spectator to the market's whims. You are a business analyst. You are a value detective. You have the tools to find those rare moments where price and value diverge wildly, and you have the mental framework to act with courage when others are frozen in fear. If the principles we've discussed have illuminated your path, if you feel equipped to look at a stock ticker not as a price to be chased, but as a business to be analyzed, then I have fulfilled my purpose. Please pay this wisdom forward. Share this video with one other person who is seeking a saner path to wealth. If you are committed to applying this checklist, let me know by clicking that like button. And if you wish to continue this journey of mastering the market's secrets through discipline and reason, then subscribe to the Behavioral Investor channel. Your engagement is what allows this message to reach other seekers of truth in a noisy world. From the bottom of my heart, thank you for your time, your trust, and your commitment to becoming a true steward of your capital. This is Benjamin Graham reminding you that the stock market is a device for transferring money from the active to the patient. Go forth, analyze with care, and invest with discipline